So I will keep it very short because I am the last one in the webinar, and so people would like to keep it short. So, so our thesis is very simple that uh, uh, so you're able to see my full screen, right? I guess, yeah. So, so private companies no longer want to IPO, and if you look at this data from, sorry, from 95, almost 40 to 60% of the VC funded companies they used to IPO. But now that number has come down significantly because of the regulatory drag and the cost of IPOs and the compliance costs, which is what it has done is that uh, because almost all the returns are now private. So if you will see, Apple returned almost 600x in private, and yet there was a 400x room in the public markets. But that has not happened with Google, Salesforce, LinkedIn, Yelp, Facebook, and Twitter. And what that has resulted in is that the investors have flocked to private equity, and we can see the numbers, which is almost 2x. So what this slide means is that $1.4 trillion was worth of primary came into the market, and $2.9 trillion. That's 2x more, but the trading volume is very low. And the biggest reason of that is because it's still offline and still paper shares that are moved, and funds and whatever. So this is this is a very nascent space at the moment. But so on the right there are some players. I mean, I'm sure people in this webinar would have heard of Forge, R Crowd, Nasdaq Private Markets. So what these guys do is, so they have said that, so these are all legacy players and they have not adopted blockchain yet, and they have said that we will try and solve it with the existing infrastructure. On the other hand, what has happened is, this is very interesting, where the Chinese security regulator themselves have decided to create an alternate exchange similar to the real estate dot exchange that DigiShares is doing, but for primary for capital markets. And this is securitize, and they've just recently raised $48 million from Morgan Stanley. So Morgan Stanley led the round, so unfair to say only Morgan Stanley. Then there is ADDX, so they're based out of Singapore, and they have recently partnered with a $7 billion B, and I'm sure some people have also heard about Republic. So what is happening is that there is some interesting players that are there, which are which are saying that we will build it from ground up, and then there are players who are saying that we will be compatible with the offline nature of the private equity, so to speak. So our platform is very simple. So I think, so essentially what we are saying is that the fund model no longer works, and that everybody in PE knows that funds are now dying because the LPs are increasingly getting direct. And that's where we come in. We say that it's a controlled auction software, wherein you have a database and you have standard legal and financial information, data room, and trading and custody of tokens. And then this is the core value proposition for an LP for trading via funds versus our platform. So if you go to a fund, right, the cost is 17%. So that's paid out over 8 to 10 years of a fund duration, and 20% carry. We say that we'll only charge a 5% transaction fee. The ticket size is very high for people to access funds, and the number of investors are very few because it's a sales problem for funds. But because we are a digital platform, for the ticket size is very low for us, and we can onboard hundreds of investors. Funds have a jurisdiction limitation because of legal issues. Our platform doesn't have any. Then there is a lock-in period of 8+2 in a fund. In our platform, it is 0 or as per regulation. So it depends on jurisdiction. Then the LPs generally have very limited visibility on the information rights and dividends on the real assets. And then secondary potential. So if you're willing to sell a interest in a fund to somebody else, in our platform, it's a direct asset that you can sell to anybody. Then because you're digitizing it, then there are valuation models that are built and it's inherently digital. But the disadvantage of our platform is that you need to have a direct buy side expertise, which you don't need in a fund. That's what fund takes care, so to speak. And so this is a product roadmap, so to speak. So over the last decade, we have built a significant sell side distribution, and we have access to $6.5 billion worth of assets over the next 5 to 7 years, for which we are looking for buy side, which the strategy for that we'll finalize by the end of this month. And then we have so right now we are launching with a deal monitor, deal room, and a tokenization module. And then, I mean, every 6 months. So it's also a function of how regulators are headed, in terms of getting the laws there, and because everybody is launching their own digital currency, and we hope, and our strategies that, and that is also what we are hearing globally from regulators, is that the moment they have their own digital currency, the wallet, the custody, and everything, so the blockchain support that is required, that they sort of enable. And so this is our focus. So I mean, it's not a very big TAM, but there is absolutely nobody, so that is why it makes sense. So it's almost a 600-700 billion dollar TAM focusing on emerging markets. And so that's our laser focus market at the moment. And so now, I mean, so now the founder has three options. So either they can IPO, either they can buy out or sell out, or either they can do a private placement offering. And what this essentially allows is that right now everybody in their cap tables have 4 people, 5 people. That's the maximum anybody has on their cap table. But with our platform, you can maximize your private placement. So you can onboard. So even today, regulators allow 200 investors. At least in India, that's the rule, that you can onboard 200 investors on your cap table. But generally, statistically, you only have 5. So why not the other 195? So that's what we believe the future is headed. So as I said, I will keep it short, and we can take up more questions in the panel. Yeah.